Imagine you're sitting at your kitchen table in early April, staring at TurboTax, and you just typed in your final W-2 number. The screen refreshes. You owe $3,847. Your stomach drops because that's not money you have. That's the vacation fund. That's 3 months of groceries. That's the transmission repair you've been putting off. And the worst part, you have no idea where that money actually went. You worked all year, paid taxes from every single paycheck, and somehow you still owe thousands more. Here's what nobody tells you about taxes. The system isn't designed to punish you. It's designed to incentivize specific behaviors. And the people who pay the least aren't the ones making the most money. They're the ones who learn to speak the language the tax code is written in. There's a specific set of moves that could save you thousands of dollars this year, and most of them have nothing to do with hiring an expensive accountant or starting a business. My name is Megan, I'm an accountant, and here I share smart financial tips that anyone can implement today. If you're tired of watching a quarter of your paycheck disappear before it even hits your bank account, and you want to actually keep more of the money you earn, make sure to subscribe and hit that like button if you find this helpful. Now, before we dive into the actual strategies, let me paint you a picture of what we're actually dealing with. The average American household paid $14,279 in federal income taxes in 2023. That's more than most people spend on rent in 7 months. But here's the kicker. 2 people making the exact same salary can have a tax bill that differs by $8,000 or more. Same income, wildly different tax burden. The difference isn't luck, it's knowledge. You're standing in line at the grocery store, mentally calculating whether you can afford the good coffee this week. Meanwhile, the person in front of you who makes exactly what you make is planning a weekend trip because they got a $4,200 refund last month. You both worked the same hours. You both earned similar money, but they knew something you didn't, and that knowledge is worth thousands of dollars. Here's what actually happens when you start thinking about taxes differently. Most people treat tax day like a pop quiz they forgot to study for. They gather their documents, plug numbers into software, and hope for the best. But taxes aren't a pop quiz. They're an open book exam where the government literally publishes the answers. The tax code is 6,871 pages of the government telling you exactly what they want you to do with your money. And every time you do one of those things, they give you a discount. Let me show you exactly how this works. Right now, if you're single and making $60,000 a year, you're probably paying around $8,000 in federal income tax. But watch what happens when you make just a few strategic moves. You open a traditional 401k and contribute $5,000. Your taxable income drops to $55,000. That alone saves you $1,100. You contribute $3,000 to an HSA because you have a high deductible health plan. Now you're at $52,000 taxable income, another $660 saved. You paid $2,400 in student loan interest this year. That's another deduction. You're down to $49,600. Suddenly, you've dropped an entire tax bracket without changing your actual earnings by a single dollar. But here's where it gets really interesting. Those aren't just deductions on paper. That $5,000 in your 401k, still your money. The $3,000 in your HSA, still yours. You didn't give anything up. You just moved money from a bucket the government can see to a bucket they've agreed not to touch. And in exchange, they charged you less. I spent an embarrassing amount of time analyzing tax returns last year, and the pattern is wild. The people paying the most in taxes aren't necessarily making the most money. They're the people who don't know the tax code has a wish list. The government wants you to save for retirement. They want you to pay for healthcare. They want you to own a home, invest in education, and donate to charity. And every single one of those actions comes with a price tag reduction. Think of it like this. Taxes are basically a negotiation between you and the government. They send you a bill, but buried in that 6,871-page manual is a menu of discounts. Most people never even look at the menu. They just pay full price. Now, you might be thinking this sounds complicated or like it requires a finance degree to figure out. But here's the thing. The biggest tax savings don't come from complex strategies or shady loopholes. They come from ridiculously simple moves that take maybe 30 minutes to set up. Let me walk you through the 7 moves that make the biggest difference for normal people with normal jobs. Number 1, max out your HSA before you even think about anything else. If you have a high deductible health plan, an HSA is the single best tax advantage account that exists. You put money in pre-tax. It grows tax-free. You take it out tax-free for medical expenses. That's a triple tax advantage. No other account does that. In 2024, you can contribute $4,150 if you're single, $8,300 for a family. That could save you $900 to $1,900 in taxes depending on your bracket. And medical expenses aren't just doctor visits. Contacts, glasses, therapy, dental work, even sunscreen. The list is massive. Number 2, contribute enough to your 401k to get the full employer match, then redirect extra savings to a Roth IRA. Here's why. The employer match is free money. If they're matching 5% and you're not contributing 5%, you're literally turning down a raise. But after you hit that match, a Roth IRA often makes more sense than piling everything into the 401k. You won't get the tax deduction now, but you'll never pay taxes on that money again. And if you're young and expecting your income to grow, paying taxes now at a lower rate beats paying them later at a higher rate. Number 3, and this is one people constantly miss, contribute to a traditional IRA even if you have a 401k. A lot of people think it's one or the other. It's not. You can do both. If you're single and make under $73,000 or married filing jointly under $116,000, you can deduct your traditional IRA contributions. That's another $6,500 off your taxable income if you're under 50. Another $1,430 in tax savings right there. Here's where most people mess this up, and I see it constantly. They get their tax refund and immediately treat it like found money. They book a trip, they buy something they've been wanting, they celebrate. But here's what that actually means. A refund isn't a gift from the government. It's your own money that you overpaid throughout the year. You gave the government an interest-free loan for 12 months, and they're just giving your money back. The goal isn't to get a big refund. The goal is to owe nothing and get nothing back. To dial in your withholdings so precisely that you keep your money all year long. Let me show you what that looks like in real life. Someone making $65,000 gets a $3,000 refund every April. They feel like they won something, but if they had adjusted their W-4 at the beginning of the year, they would have had an extra $250 in every single paycheck. That's $250 that could have gone to paying off high-interest credit card debt that's costing them $80 a month in interest. Over the year, that free money refund actually cost them $960 in unnecessary interest payments. But here's the part that will blow your mind. The tax code is set up to reward future thinking. Every dollar you put toward retirement, healthcare, or education is a dollar the government won't tax. They're basically saying, if you're going to be responsible and plan ahead, we'll cut you a deal. And the earlier you start taking advantage of this, the more dramatic the impact. Let me give you a real example. Two people, both 28 years old, both making $55,000 a year. Person A doesn't touch their 401k, doesn't bother with an HSA, takes the standard deduction and pays about $7,200 in federal taxes. Person B maxes their HSA at $4,150, contributes $8,000 to their 401k, and pays $4,800 in taxes. Person B saved $2,400 this year. But here's the really wild part. That $12,150 they tucked away, in 30 years at a 7% return, that's worth $92,000. Person A has nothing. Person B has $92,000 and they paid $2,400 less in taxes to get it. And this is something that will probably surprise you. The tax savings aren't even the biggest benefit. It's what happens to your brain when you stop living paycheck to paycheck. When you have money in a 401k, in an HSA, when you're actually building something, you start making different decisions. You stop taking the job that pays $3,000 more but makes you miserable because you're not desperate. You negotiate harder because you have options. You walk away from terrible deals because you're not cornered. There's this moment that happens when you hit about $25,000 in retirement savings. You check your balance and you realize for the first time that the money is growing faster than you're adding to it. You put in $500 last month, but your account went up $800 because of gains. That's when it clicks. You're not just saving anymore. You're building a machine that generates money while you sleep. Now, let's talk about the moves that apply if you have any kind of side income, freelance work, or a small business. Even if you just sell stuff on Etsy or drive for Uber occasionally, because this is where the tax code gets really interesting. The government wants you to start businesses. They want entrepreneurship. So they made the tax benefits for business owners significantly better than the benefits for employees. If you have a side hustle that makes even $5,000 a year, you can deduct your home office, a portion of your rent or mortgage, utilities, internet. You can deduct your phone bill, your computer, software subscriptions, equipment, supplies, even mileage if you drive for business. I'm not talking about shady deductions. I'm talking about legitimate business expenses that directly reduce your taxable income. Here's what that looks like in numbers. You made $5,000 from freelance graphic design this year. Without deductions, you'd owe about $1,450 in taxes and self-employment tax. But you have a dedicated workspace in your apartment. That's $1,200 in home office deduction. You bought a new laptop for $1,000. You paid for Adobe Creative Cloud at $55 a month, so $660 for the year. You drove to client meetings 800 miles at 67 cents per mile. That's $536. Your total deductions are $3,396. Your taxable income from the side hustle drops to $1,604. Now you owe about $460 in taxes instead of $1,450. You saved $990 by keeping receipts and tracking expenses. But here's where most people completely miss the point. Tax strategy isn't about finding loopholes or playing games with the IRS. It's about understanding what the government is trying to encourage and aligning your financial decisions with those incentives. They want you to save for retirement because they don't want to support you when you're 80. They want you to pay for your own health care because it reduces the burden on Medicare. They want you to own a home because it stabilizes communities. Every tax break exists because the government decided that behavior is worth subsidizing. The people who pay the least in taxes aren't cheating. They're reading the manual and doing exactly what the government asked them to do. And the reward for that is keeping more of their own money. And here's the kicker. Most of these strategies don't require you to change your life. You're already going to spend money on healthcare. Put it in an HSA and save on taxes. You're already planning to retire someday. Put money in a 401k and save on taxes. You're already paying student loans. Make sure you're claiming the interest deduction. You're already donating to charity. Keep the receipts and itemize if it beats the standard deduction. This isn't about deprivation or sacrifice. It's about routing your existing money through accounts that come with a government discount attached. Now let me tell you the biggest mistake I see people make once they learn this stuff. They go too hard, too fast. They try to max out every account, claim every deduction, optimize everything all at once, and they end up cash poor. Because here's the thing, tax savings are great, but not if you have to put an emergency car repair on a credit card at 24% interest because all your money is locked in a retirement account you can't touch for 30 years. The order matters. Emergency fund first, at least $1,000, ideally $5,000. Then high interest debt, anything above 7%. Then employer 401k match because that's free money. Then HSA if you have one. Then Roth IRA, then max out 401k if you can. Then taxable investments. This order protects you from life's chaos while still building wealth and reducing taxes. Start with one move, just one. Open an HSA and contribute $100 a month, or bump your 401k contribution up by 2%. That's it. Don't try to overhaul your entire financial life in a weekend, because the goal isn't perfection. The goal is progress. And the difference between someone who pays $8,000 in taxes and someone who pays $5,000 isn't that one of them is smarter. It's that they made 3 or 4 different decisions over the course of a year. Your tax bill isn't random. It's not something that just happens to you. It's the direct result of choices you made or didn't make over the past 12 months. And the beautiful thing is, you get to make different choices next year. Start building that tax strategy today because your future self is counting on the decision you make right now. The government already told you how to pay less. You just have to listen.